Today, I'd like to share some useful insights on how to construct a solid private assets portfolio. Private assets have undoubtedly been an attractive asset class, offering compelling risk-adjusted returns. However, their unique characteristics and specificities set them apart from traditional liquid assets. Factors such as the cash flow dynamics of commitments, capital calls, and distributions, the complexity of achieving desired exposure and timing, and the challenges of identifying and accessing the best global investment opportunities underscore the need for a detailed and well-thought-out long-term investment plan. With this in mind, we recommend following a three-step process before venturing into private assets investments. Step 1. Define your long-term investment objectives. The foundation of any resilient private assets strategy begins with clearly defining your long-term investment objectives. These objectives typically focus on three key areas: targeted risk-return metrics, cash flow requirements, and desired portfolio exposure, whether in absolute dollar terms or as a percentage of your assets under management. Having a clear understanding of these priorities will provide direction and purpose to your investment decisions. Step 2. Design a long-term commitment strategy. Once your objectives are well defined, the next step is to craft a long-term commitment strategy aligned with those investment goals. This involves several key decisions. Asset class selection. Determine which private asset class you want to invest in: private equity, real assets, private debt, venture capital, or others. Sub-strategy alignment. Within each asset class, identify the sub-strategies that best match your objectives. For instance, if you require steady cash flow, consider overweighting core real assets or direct lending funds. Or, if you aim to build exposure quickly, prioritize secondaries over primaries in the early years of your private equity allocation. Be aware that committing only into primary funds might imply reaching your target allocation in between 7 to 9 years. Including secondaries will give you some flexibility to accelerate your exposure objectives or, if necessary, reduce your exposure faster as well. And risk profile and diversification. Define your geographic, sectoral, and investment size preferences. And most importantly, ensure vintage diversification. Attempting to time the market can introduce unnecessary risk. Instead, aim for consistency in your commitments. This second step should conclude with a clear annual commitment strategy for each private asset class, serving as a roadmap for long-term investment decisions. And finally, step 3. Develop robust monitoring and administrative tools. The third and final step is to establish adequate monitoring and administrative capabilities, which should include a look-through of your portfolio. These tools will help you track your portfolio performance in real time, identify deviations from your long-term plan early, and implement corrective actions effectively by adjusting your commitment strategy when necessary. Proper monitoring ensures that your portfolio stays aligned with your objectives and can adapt to changing market conditions and unforeseen challenges. In conclusion, investing in private assets is a long-term endeavor that requires comprehensive investment plan, thoughtful strategy design, and specialized skill sets. By following this three-step process, defining objectives, creating a commitment strategy, and developing robust monitoring capabilities, you can build a resilient private assets portfolio.